Warren Buffett is one of the richest people on the planet, but the way he gets paid is not what most people imagine. There is no screen full of flashing charts, no frantic buying and selling, no obsession with timing the market or predicting the next hot stock. His wealth does not come from trading. It comes from something far quieter, far slower, and far more reliable. Cash flow. Specifically, dividends from businesses so stable that they keep paying him whether the market is booming or collapsing. Most investors think wealth is built when you sell at the right time. Buffett knows wealth is built when you never have to sell at all. His system is designed to generate money while he waits, while he sleeps, while markets panic. It is boring by design, and that boredom is exactly what makes it powerful. At the center of this system are dividend-paying companies, not the kind that promise explosive growth or overnight riches, but the kind that quietly print money year after year. Buffett doesn't chase excitement. He buys businesses that already work, businesses that people rely on regardless of economic conditions, and he holds them for decades. Those businesses send him cash simply for owning them. Not because he did anything that quarter, not because he timed anything correctly, but because the business kept operating. Dividends are often misunderstood. They are not free money. They are a company returning a portion of its profits to the people who own it. A business earns revenue, pays its costs, reinvests what it needs to keep growing, and if it has excess cash, it has a choice. It can sit on it, it can waste it, or it can give it back to shareholders. Buffett favors companies that respect that last option. To him, dividends are not just income. They are proof. Proof that a business generates more cash than it needs. Proof that management is disciplined. Proof that profits are real, not just accounting illusions. And most importantly, dividends are usable capital. Cash that can be redeployed into new opportunities without selling anything. Take Coca-Cola, one of the most famous investments in history. Buffett began buying shares in the late 1980s, during a period when the company was temporarily out of favor. He didn't buy because soda was exciting. He bought because Coca-Cola sold a product consumed daily by millions of people around the world, had unmatched brand power, and generated enormous free cash flow. Today, Berkshire Hathaway owns roughly 400 million shares of Coca-Cola. Coca-Cola currently pays an annual dividend of $1.84 per share. That means Berkshire collects approximately $736 million per year in dividends from this single investment. That breaks down to around $184 million per quarter, or just over $2 million per day, every day, without selling a single share. What makes this even more remarkable is that Buffett originally invested about $1.3 billion to build that position. Over time, Coca-Cola increased its dividend repeatedly. Buffett's yield on cost, the return he earns based on what he originally paid, is now estimated to be well over 50% annually. In practical terms, that means Coca-Cola sends him back roughly half of his original investment every year, and he still owns the entire position. This is the power of time combined with growing dividends. Most investors focus on dividend yield today. Buffett focuses on dividend growth over decades. He is willing to accept a modest yield up front if the business has the ability and incentive to raise payouts over time. What starts as a trickle becomes a flood. And Buffett doesn't spend those dividends the way most people imagine. He doesn't pull the cash out to buy luxury items or inflate his lifestyle. He reinvests it. Dividends from Coca-Cola are used to buy stakes in other companies. Dividends from those companies then generate even more cash. The system feeds itself. Capital creates income. Income creates more capital. The loop tightens over time. This is why Buffett places such an emphasis on holding period. He has famously said that his favorite holding period is forever. That statement is often misunderstood as stubbornness or emotional attachment. In reality, it's a mathematical strategy. Selling interrupts compounding. Selling triggers taxes. Selling converts a cash-producing asset into a one-time event. By holding, Buffett lets the business do the work. As long as the company remains strong, profitable, and well-managed, there is no reason to exit. The dividends keep coming whether the stock price is up, down, or flat. Volatility becomes irrelevant. To understand how powerful this is, consider a simple example. Imagine investing $10,000 into a company that pays a 4% annual dividend and increases that dividend by 6% per year. In the first year, you earn $400. If you reinvest it, your investment grows to $10,400. The next year, the dividend is higher, and it is applied to a larger base. Over time, the growth accelerates. After 30 years, without adding any new money, the annual dividend alone can exceed the original $10,000 investment. This is not theoretical. This is exactly how many of Buffett's holdings behave. The key is patience and discipline. Most people never let compounding mature. They interrupt it too early. Buffett pairs this dividend strategy with an obsession over business quality. He avoids companies that require constant reinvestment just to stay alive. He prefers businesses with durable competitive advantages, pricing power, and predictable demand. Products people buy out of habit, not impulse. Soft drinks, insurance, consumer staples, financial services with deep moats. One of the clearest examples outside of publicly traded stocks is a candy company Buffett bought in 1972. The business required very little capital to operate, had strong brand loyalty, and generated consistent profits. It did not need aggressive expansion or innovation. As a result, it sent most of its earnings back to Berkshire as cash. Over the decades, that single acquisition returned many times its purchase price in dividends alone, and the business itself continued operating profitably. Buffett refers to these types of businesses as cash generators. They don't demand attention. They don't demand reinvention. They simply produce money. That money can then be allocated to higher growth opportunities elsewhere. This approach also explains Buffett's calm during market crashes. When prices fall, most investors panic because their only plan to make money is to sell later at a higher price. Buffett doesn't rely on selling. His companies keep sending cash regardless of market sentiment. During downturns, that cash becomes even more valuable because it allows him to buy assets at discounted prices while others are forced to liquidate. This is exactly what happened during multiple crises, from the dot-com collapse to the financial crisis of 2008. While markets were in chaos, Berkshire Hathaway's businesses continued to operate. Insurance premiums were collected, products were sold, dividends were paid. Buffett used that incoming cash to make some of the most profitable investments of his career. This system also changes how risk is perceived. Buffett is not immune to price declines, but he is insulated from emotional decision-making. When income continues uninterrupted, volatility loses its power. Fear thrives on uncertainty. Dividends reduce uncertainty. The brilliance of Buffett's approach is that it does not depend on being right often. It depends on being right a few times and holding on. A small number of exceptional businesses held for decades can outperform hundreds of trades. As Buffett himself has said, you don't need to swing at every pitch. You only need to wait for the right ones. Dividends give him the patience to wait. And this is where most investors fail. They confuse activity with progress. They chase price movement instead of business performance. They ignore cash flow and obsess over valuation models that assume a future sale. Buffett designs his investments so that selling is optional, not required. By the time people notice how powerful this strategy is, it often looks unattainable. They see billions in annual dividends and assume it required brilliance or insider access. In reality, it required restraint. Buying businesses that make sense, paying reasonable prices, reinvesting consistently. And above all, doing nothing when doing nothing is the hardest option. This is only the foundation. The companies that built this system, the exact dividend machines that turned theory into billions, and the modern investments that continue to expand this cash engine, are where the story gets even more interesting. Once the foundation is understood, the real picture of Buffett's dividend strategy comes into focus through the companies that transformed it from theory into an income engine. These were not lucky guesses. They were deliberate choices rooted in durability, cash generation, and behavior that could survive decades of economic change. Each one reinforced the same lesson. When you own businesses that keep paying you, time becomes your ally instead of your enemy. After Coca-Cola, one of the most important dividend pillars in Buffett's portfolio has been American Express. His involvement with the company dates back to the 1960s, during a crisis that caused widespread panic among investors. At the time, American Express was dealing with a scandal tied to a subsidiary, and the stock was punished aggressively. Buffett looked past the headlines and focused on customer loyalty, brand trust, and the company's dominant position in premium credit services. He invested heavily when others fled. That decision paid off for decades. American Express evolved into one of Berkshire Hathaway's most valuable holdings, generating hundreds of millions of dollars annually in dividends. What mattered was not the yield at the time of purchase, but the growth of the business and its ability to return capital consistently. Each dividend increase compounded the original decision. As with Coca-Cola, Buffett never needed to sell to realize gains. The income stream alone justified the patience. Another classic example came through Procter & Gamble, a consumer products giant whose brands are embedded into daily life. While Berkshire eventually exited most of its direct position, the years of ownership were marked by steady dividend growth and dependable cash flow. Products like toothpaste, razors, detergent, and hygiene items do not depend on economic optimism. They are purchased in recessions and booms alike. That predictability is exactly what Buffett values. The common thread among these companies is not sector or innovation. It is habit. Buffett invests in behaviors that repeat automatically. People drink soda. They brush their teeth. They use credit cards. They insure their assets. Habits produce revenue stability, and revenue stability supports dividends. What truly separates Buffett's approach from conventional income investing is how aggressively he reinvests those dividends. Many investors treat dividends as spending money. Buffett treats them as ammunition. Every dollar received increases his ability to act when opportunities arise. This is why Berkshire Hathaway can deploy tens of billions of dollars during market stress without scrambling for liquidity. As Berkshire grew, the dividend income scaled to extraordinary levels. Today, Berkshire Hathaway collects well over $4 billion per year in dividends across its portfolio. That number fluctuates, but the direction has been consistently upward. This income arrives without selling assets, without leverage, and without speculation. It is raw cash generated by ownership. Critics often point out that Buffett himself does not pay dividends from Berkshire Hathaway stock. This is not a contradiction. It is an extension of the same philosophy. Buffett believes Berkshire can reinvest retained earnings at higher rates of return than shareholders could achieve on their own. As long as that remains true, retaining capital creates more value than distributing it. When that changes, dividends become appropriate. This principle explains why Buffett is selective, not dogmatic, about dividends. He is not chasing yield. He is evaluating capital allocation. If a company can turn $1 into more than $1 over time through reinvestment, he prefers that. If it cannot, he wants the cash back. This brings us to Buffett's more recent investments, where many observers mistakenly believe he has abandoned dividends. In reality, he has simply adapted the same framework to a modern economy. The most obvious example is Apple. Buffett began accumulating Apple shares in 2016. At the time, many were confused. Apple was viewed as a technology company, and Buffett had long avoided tech due to unpredictability. But Buffett did not see Apple as a tech stock. He saw it as a consumer ecosystem with extraordinary brand loyalty, pricing power, and recurring revenue. The iPhone was not a gadget. It was a habit. Apple pays a modest dividend, currently yielding around 0.5%. On the surface, that seems insignificant compared to traditional income stocks. But scale changes everything. Berkshire owns hundreds of millions of Apple shares, translating into roughly $300 million per year in dividends. More importantly, Apple aggressively buys back its own stock, increasing Berkshire's ownership percentage automatically. Buffett receives growing income and expanding ownership without additional capital. This is dividend strategy in modern form. Cash flow plus capital efficiency. Apple retains most of its earnings, reinvests them at high returns, and still rewards shareholders. Buffett gets paid while compounding accelerates underneath him. Bank of America represents another pillar of Buffett's modern dividend income. He began investing heavily after the financial crisis when banks were widely despised and tightly regulated. Bank of America rebuilt its balance sheet, strengthened its capital position, and resumed dividend growth. Today, Berkshire collects hundreds of millions of dollars annually from this single holding. Buffett's confidence in Bank of America stems from scale, diversification, and regulatory entrenchment. Large banks with strong capital ratios are unlikely to disappear. They may suffer margin compression, regulatory pressure, or cyclical downturns, but they continue operating. That endurance supports dividends. Energy has also become an increasingly important source of income for Berkshire Hathaway. Chevron stands out as a prime example. Buffett has invested tens of billions into the company, attracted by its disciplined capital spending, shareholder-friendly policies, and long history of dividend payments. Chevron's dividend yield is typically well above the market average, and it has increased its payout consistently for decades. Occidental Petroleum, another major energy position, reflects Buffett's willingness to blend income with future potential. While its dividend yield is lower than Chevron's, the company has focused on debt reduction, operational efficiency, and shareholder returns. Buffett's growing stake signals confidence that the dividend stream will strengthen over time. Then there is Kraft Heinz, a more controversial holding. While the stock price has struggled, the dividend has remained substantial. Buffett's ownership delivers significant annual income despite muted capital appreciation. This illustrates an important nuance. Dividends can compensate for lackluster price performance when the business remains cash generative. When all of these holdings are viewed together, a pattern emerges. Buffett has constructed a diversified dividend ecosystem spanning consumer products, financial services, energy, and technology. Each stream operates independently. When one sector faces pressure, others continue paying. This diversification stabilizes cash flow and enhances optionality. Optionality is one of Buffett's most underappreciated advantages. Consistent dividend income gives him flexibility. It allows him to act decisively when valuations compress. It allows him to negotiate from a position of strength. It allows him to remain patient without fear of missing out. This system also explains why Buffett appears unfazed by short-term underperformance. He is not judged by quarterly price movements. His success is measured in decades of cash accumulation and redeployment. As long as the income grows, volatility is noise. Many investors attempt to replicate Buffett's results by copying his stock picks without adopting his mindset. This almost always fails. The real advantage is not access to certain companies. It is the ability to hold them through boredom, stagnation, and fear while reinvesting relentlessly. The final question everyone asks is, which of Buffett's current holdings could become the next Coca-Cola? The honest answer is that no one knows with certainty. But the criteria are clear. The next great dividend engine will be a business with entrenched habits, pricing power, global reach, and disciplined capital allocation. It will grow slowly, predictably, and quietly. And it will reward patience far more than excitement. Buffett has never tried to predict the future. He positions himself to benefit from persistence. His dividend strategy is not about maximizing yield. It is about maximizing endurance, cash flow that survives recessions, businesses that outlive trends, systems that work even when nothing else does. That is why his wealth continues to grow regardless of headlines. While others speculate, he collects. While others react, he reinvests. While others trade, he owns. And that is the lesson most people miss. Buffett's dividend empire was not built by brilliance alone. It was built by restraint, structure, and time. The same ingredients are available to anyone willing to trade excitement for inevitability.